As I work some weekends on my day job, I get some time off during the week, and that time is coming up now. So I wanted to share a few things with you before I go away to this place. There's no reception there, so you can imagine how peaceful it is, and I look forward to it. But I couldn't put it off to not share a few things that I've just looked into. First, a reminder about the housing prices. So, Sydney, this is a CoreLogic report that I found on their website, and it says Sydney dwelling values increased by 1.7% in September and 3.5% over the 3 months to September 2019. Sydney dwelling values have fallen by 4.8% over the past year, and there are currently down 11.9% lower than the high in July 2017. So just for the reference, today is 9th of October 2019. So while there's this resurgence in prices in Sydney and Melbourne pretty much, so 3.5% up over the 3 months to September 2019, let's remind ourselves that overall from its peak in 2017, the Sydney housing prices are down nearly 12%. So my point here is that we're not out of the woods by any stretch of imagination yet. And until all of the major property centers, so capital cities and regionals, start going up and show the trend up or down, we can't call it one way or the other. Just like the gold needs to be showing the trend in all the major currencies around the world before we can call it exploding or imploding at any point in time. The same goes for the property. It needs to be going up, not just in Sydney and Melbourne. A good example is Perth. So during the last month and the last quarter in Perth, so Perth dwelling values fell by 0.8% in September, and they were 1.9% lower over the 3 months to September 2019. Perth dwelling values have fallen by 9% over the past year, 12 months only, and they are currently 21.3% lower than their June 2014 peak. Once again, whilst Sydney and Melbourne have turned around somewhat, just ever so slightly, the rest of the market is flat at best, if not negative. Remember the powerhouse of Hobart? Hobart dwelling values fell by 0.4% in September, and they were 0.4% higher over the 3 months to September 2019. This means that whilst looking at the 3 month picture, they are up, but the last month, which shows you what pretty much happened just recently, it's down 0.4%. So it's turning around down uh, once again, following the rest of the country and not necessarily Sydney and Melbourne. And so, reading on, Hobart dwelling values have increased by 2.5% over the past year. This is the powerhouse of Hobart, and they are currently 0.7% lower than their March 2019 peak ever. So overall, they're actually down 0.7% overall, yet that's one of the best performing cities in Australia since the downturn began in mid 2017. As far as the recommendation of my number one source, ArmstrongEconomics.com, seeing in my opinion that it's the only unbiased source and I have to go off of something, not just my opinion. A viewer from Europe, granted, I know, people will say Europe is much different to Australia, and it is, and it is in a lot more trouble than Australia will ever be at this stage. A reader wrote in asking what's the best thing to do: buy property now, rent it out, or just buy stock, or stay save and continue saving cash and stay liquid. So this is the answer that was given. So once again, the person writing in was from Denmark. This is what Martin has to say. I believe the best thing is to remain liquid, and equities tend to do better or to be the better road rather than investment property, which is not movable. The next paragraph is all I needed to hear, not to jump into buying overly expensive property. It says, we all need a place to live. So, what I'm talking about is investment properties. They will be highly dependent upon banks willing to lend mortgages. As the banking sector get hit, you will find that the liquidity in real estate will dry up very rapidly. And I think this paragraph stands for Australia and pretty much the rest of the world, because if banks get in trouble, which they are, which is my next point, there will not be liquidity and the prices will go down. So what he's saying here, exactly what I've been saying, is that it is important to own your home, not at all cost, but we all need place to live. Sure, what he's talking about is that investment properties. If you were and you had some extra spare cash, want to park it somewhere and buy investment property, he's pretty much saying don't, because they'll come down in value due to banking getting in trouble and tightening the liquidity, which is exactly what holds the real estate up. I deliberately didn't want to reveal the title of this article, which of course I'm going to post and have in the description box. Staying liquid may be the best bet. And just going back to the point that until all of Australia's real estate turns around and shows green shoots, we are not out of the woods. So, simplistically looking at the chart of real estate, so it's gone up for years and years, and it's reached peak, say, in Sydney, Melbourne at mid 2017. So it's turned down and it's just ticked back up for the last quarter. Now, if we were to use the charting analysis of that, we would know that this is the resistance line, the blue line, right? So if we were to see and to be 100% or more than 50% sure that property can continue to go up, the property prices would need to turn back up. So they're up, they need to continue going up, or in any case, break through that resistance. Whether it goes sideways for a little while, it's irrelevant. But until this point here, we don't know. If the basic charting analysis will tell you that if the property is found to have broken through its high here, which we know that for the major markets of Sydney and Melbourne was June or mid 2017 in any case, then we can say, look, we are out of the woods, the property continues to go up, and it is expected to go up. This is kind of a 101 charting that almost closely limits my knowledge of it, but I do know that much. I, however, think that it's going to edge up a little bit more for the next few months towards the end of 2019, and then eventually it's going to find its way down again. Not excluding or absolutely discounting the fact that it may do exactly the same thing again and again before eventually one day turns back around. But we're talking potentially years and decades. So how is it possible that price of anything, let alone housing that we're used to seeing in the uptrend, can go sideways or down for decades? Look at the long-term chart of Australian real estate, starting from a downturn in 1890, right? So it started dropping right about there, and it went sideways for nearly 50 years before it recovered. Now it's different this time, is it? Okay, so before we go into talking about what's going on with the banks, I want to again refer you to this chart, which I got from, it's a screenshot from a video that I just watched. I can't say I follow the channel or I've seen anything from that channel in the past, but I am going to post the link to that video that I think you must watch. I mean, I think I've touched on a 1% of that video, which is not even a video, it's like a mini documentary, but it's not that long. And it's titled Australia Property Bubble, What the Long-Term Data Shows. It's actually incredible. I wouldn't be surprised that some of you viewers have seen it. It's 6 months old. I think I've seen this thumbnail for a while and just never clicked on it. 95,000 views by now. Story IQ. Go watch it. Um, I agree 100%. Okay, the banks are in trouble, at least twofold. One of them is this.
ANZ has taken another $500 million hit to profits, the latest of the big four to reveal the ongoing financial pain of fixing problems exposed at the Royal Commission. A new bill of $559 million after tax will pay for customers hurt by scandals and rorts. Australia's third largest bank says it has more than 500 staff working on the issues. The new WACC takes the cost of remediation north of $1.1 billion for ANZ. Hayne Payne continues for the big four banks, with the ever-increasing compensation bill from the Royal Commission now approaching $10 billion. Last week, NAB drastically lifted its compensation bill to $1.2 billion.
Whilst I think that this remediation bill of $10 billion across all the banks, or at least the big four, is probably inflated, as they're probably throwing all sorts of different other costs into that so they can blame the Royal Commission 2018 as opposed to blaming their own mistakes and other customer rip-offs. Nevertheless, they are going to write that off on tax, and they are going to have to take that out of the operating costs and their profits. So that will reduce the profitability of the banks further. I am not saying this because I feel sorry for the banks, and before we start commenting how bad the banks are, they are. What I'm saying it for is that if you are thinking about buying shares, don't go into banking shares. They're not going to do very well in the not too distant future. Just my opinion, not financial advice, obviously. And second, even bigger reason why I want to stay away from the banks is that the profit margins for the big four banks tip to feel lower rate squeeze. As the Reserve Bank of Australia is reducing the official cash rate and continues to do so, the net interest margins are dropping off the banks, and there's not very much they can do about it. This is why their share price has been languishing and languishing hard, not just sideways. So this article says a decline in interest rates on deposits towards zero is in turn putting the squeeze on the bank's net interest margins, NIM, the difference between banks' funding costs and what they charge for loans. This occurs because the rates get lower, a growing proportion of the bank's deposits are paying nothing or close to it, so cannot be cut further. Although banks are also benefiting from a fall in their wholesale funding costs, stockbroking analysts say the overall impact of further cash rate cuts will be to crunch net interest margins, which are a key influence of bank profitability. So key influence of bank profitability goes down, banks go down. And by that, I don't mean they go out of business. It just means that their profitability tanks, which means their dividends will most likely be cut, which means that their overall share price is going to go down. Here's the latest interest rate cut that happened on the October 1st by the Reserve Bank of Australia versus the Commonwealth Bank of Australia CBA share price. Look what happened on the October 1st. So that's the price of October 1st. That's when the Reserve Bank cut interest rate down from 1% to 0.75%. And what happened to the price of the CBA? It's gone down. It doesn't mean it continue to go down. It actually somewhat recovered since then. But it is the sign that central banks and Reserve Bank of Australia cutting interest rate is not good news for the actual banks. Okay, as I said, I'm going to include all of the links in the description below, and especially the video, or almost like a mini documentary, Australia Property Bubble, what and the long-term data shows, down in the description. So go ahead, watch that, please, and let me know what you think about that video. It's very level-headed, balanced, and it just takes a step back and it says, okay, what can we expect? Is it unreasonable to expect that the property goes down 40% or goes sideways for 30, 40 years? And is Australia all that different? He makes a great case. Please go watch it. In the meantime, stay liquid, be well, and bye for now.